Hello and welcome to this version of the Property Forum chat show with myself, Nicholas Woolwork. Today I'm going to be joined shortly by the wonderful Kate Faulkner. And we're going to be going through the current state of the UK property market. We're going to be looking at potential predictions on pricing. We're going to talk about the current market, the future market, the structure of the housing market. There's been some recent changes in PD rights recently, so we're going to probably touch upon those kind of changes as well. But for any of you that don't know the show, please subscribe. You hit the bell icon for being notified to see sort of future episodes. And we talk here about anything property, investment, development, state of the market. We try and impart as much wisdom from myself and my guests as we can, try and help you guys out there make better investments, make safer investments, and to help you along your journey. For those of you that don't know me, I'll do a quick introduction if I may. I'm the CEO of Property Forum. We also have our development company, Red Brick. I'm an international author for the For Dummies brand. I've authored the Investing in International Real Estate book, as well as more recently Brexit for Dummies for my sins. I'm a multi-millionaire property investor, developer and market commentator, and also help people on their own journeys, mentoring them and getting them going, and helping often more experienced investors grow their portfolios and move forward with their careers and where they might be stuck. Without further ado, I would like to bring Kate onto the show. So welcome today, Kate. Thank you very much for joining us. Really appreciate it.
Always a pleasure.
Fantastic. So let me do a quick introduction to Kate. For those of you that don't know her, and I'm sure there's a lot of you out there that do, Kate's one of the leading property experts in the UK. She's a property commentator, she's an analyst, and she's the owner of Designs on Property Limited. So yeah, great to have you here, Kate. We've got a bit of an agenda today. We've got a few items to go through. I'll quickly sort of talk the audience through what we're hoping to cover. We're going to talk about the prediction in the UK house prices. We're going to have a chat around that in 2021. How's the structure of the housing market changing? That's kind of critical. There's definitely a push for government into bigger investors and institutional investment, that kind of stuff. Is UK property still a good investment option? We're going to talk about that, I'm sure, cover that maybe in various segments. Is the UK property market expected to crash? That's a big question. People are worried about, they're holding off. Is it going to crash? Obviously, we don't have a crystal ball, but we're going to talk around these kind of topics. PPE, the property market, politics and the economy. We're going to cover various topics there. Current stats and forecasts and why these might be right and wrong. And forecasting challenges due to the political uncertainty with Brexit. And Kate's going to do a wonderful presentation she's prepared for us to get us going shortly, and a Q&A session after that. But, before we start off, Kate, how have you found it? It's all a bit crazy at the moment, isn't it?
Mental is the only description I can give it. We do a lot of writing for companies. We do a lot of the media, as you say. And also in the background be involved in two consumer groups where we actually work cross industry, all the different trade associations, and indeed MHCLG. So that's across home moving and the private rented sector. And it's a little hard to get everybody together at the start, but one of the things that has happened, which you'll kind of never notice, but it's worth knowing, is the home moving industry's really, really come together over the last few months, and we worked very hard on getting the guidance right to open up the market. And I think we did a good job of that. We've certainly not had the complaints that other sectors have had. And of course, nobody expected anything like the crazy times that we have at this moment, and considering we all know house prices are going to fall, for them to suddenly grow by 2 or 3% this year is just unbelievable. Defies anything we've ever seen before.
It's kind of crazy, isn't it? I mean, it kind of feels like there's a bit of partly pent up demand potentially from being in lockdown. People wanting to get back and either move home if they're house movers, or investors just wanting to get cracking again. We're kind of a bit sick of being locked in our houses, want to get out and do stuff. And I guess things like the PD changes that are coming in, and there's certainly more PD changes coming in July. You've got the stamp duty reforms allowing less stamp duty to be paid, haven't we? Till is it March next year? I always forget the dates, but
yeah, and that's really what. So we're kind of looking at some sort of new stats this week that sort of say first-time buyers are taking a lower proportion of the market, and it's important to understand that it's not necessarily there has been a slight drop volume-wise, but actually the big jump in sales, and the big sort of driver of prices has definitely been houses. And it's very much second steppers or people downsizing. So that's where we're seeing the extra business come in, and a lot of that is driven by the desire to save stamp duty, which 15 grand down south, few £100 everywhere else, to be honest, Nicholas. So
Yeah, I was going to
it's a
say.
bit of a. I think in Nottingham, where I'm from, I think it saved you, I don't know, £420 or something. So
Wow. Well,
although
don't spend it all at once.
Nottingham taxpayers paying for the 15 grand probably weren't quite as happy after my conversation. So it is that. So it's very much people bringing sales forward, and that's the bit to remember, is that this, we all know
True.
this can't carry on and won't. We're just not sure when the sort of various cliff edges are going to happen.
No, exactly. It's been a bit of a strange time as well. We've had some issues. We were mentioning just before this stream that we've been working with a lender that's been particularly slow, taking almost 3 months just to get 3 straight buy-to-let mortgages through. So it's a bit varied. There's this demand going on, but then finance isn't particularly quick in any field, I can tell. Have you had much, experience with lenders in the last sort of 3 or 4 months? Well, 6 months, I guess now.
Yeah, so we've been working right across the industry. The referral or deferral of mortgage payments. I think we perhaps didn't appreciate quite how much
How
of
much
the
work that
lenders'
was.
time that was taking. That was phenomenal, and that has really been quite a hefty burden for them. Whether you feel sorry for them or not, it's a different matter. Um, and there is then the kind of nervousness at this moment. There was quite an early nervousness, which has come off a little bit, meaning lenders are being a bit more generous on occasion. But I think certainly not just on the lender side, but on the legal side, the industry is almost at max capacity. And the people are saying that they haven't seen times like this since way back into 2006, and before then. So I'm afraid we're all going to just have to accept that, unfortunately, the pickup wasn't expected, it wasn't predicted, and as a result of that, it's really maxed out a lot of the professions.
Okay. Well, look, I know you've prepared a bit of a kind of presentation for us just to kind of get things kicked off from your point of view with a bit of research you've done. So would you mind sharing that with us, and we can kind of go through some Q&A after that? We've had lots of questions in. Just before we jump into that presentation, Kate, at every opportunity, guys, those of you watching, please do jump in and post your questions live on the chat. I think we might have not connected with quite the right link on YouTube when we started this, but there's a live stream going on YouTube, so everyone that's on that, and I can see there's quite a few people on it, please do post your questions in the chat, and we'll prioritise those as we go along. But yeah, over to you, Kate, if you'd like to get share your presentation and get that up on screen, and we'll have a chat more afterwards. Over to you for a few minutes.
Let's get this shared. There we go. If you
That's
shout,
looking
tell
good.
me if
Yeah,
you
that's
can.
come up.
I'm just putting it on. Always takes a little while, doesn't it? There we go. There we go. Can you see that?
You can see that? Yeah, that's perfect.
Brilliant.
Go for it.
So what I've done basically, I always like to make sure I deliver, and please do ask questions. I like answering questions. It's one of my favourite things. So don't forget to do that, and challenge me as well. I don't believe that I know everything, so I'm always happy to hear other thoughts. So one of the topics was kind of where next for rents and prices, and rents are actually one of the most easiest markets to predict, for the simple reason that they're influenced by 4 things: wage inflation and ordinary inflation, and supply and demand. So unlike the price market, what happens in the rental market is that rents do go up, but as you can see from this chart, they typically only go up when wages are rising at a faster level than the general cost of living. And basically, what the rental market does is, if people have got more money in their back pocket, then they can pay more for rent. If they haven't got more money in their back pocket, they're going to find that a little bit more difficult, and rents flatline. Doesn't happen the same in property prices anymore, because that's a different financial dynamic. So as a result, we're not going to see there's a be a very tiny number of people that are going to see good wage growth over the next 12 months for obvious reasons. So our expectation is, and pretty much if you want to look at some good forecasters at the moment, Hometrack's producing some cracking reports. Savills have got some good stuff, and actually Hamptons have also done a good prediction on what's happening as well. But if I were in your shoes and you're renting or you're looking to get into buy to let and see what happens in the rental sector, ideally you would always aim to increase your rents each year in line with inflation, because that's the best way to go. It covers your increasing costs every year. And that's going to be a bit tough over the next year or two. So we're expecting rents to flatline. The only place where that's not going to happen, and we're definitely seeing rents falling, is in London. And the main reason for that is that's where the supply and demand element is coming in. People are moving out and renting somewhere else other than London where they can, because of course they can do it for a 6-month contract. And quite a lot of big companies have said to people, not, don't worry about coming back till after kind of March next year. And the result of that is that the demand in London isn't as it normally is, so it's not kind of rampant, for want of a better phrase. But equally, the big pressure actually is from supply. So supply has jumped substantially in areas like London and indeed Edinburgh. And the reason for that is the short-term accommodation market has been a bit hammered over the last few months. And as a result of that, the stock is moving back into the private rented sector. So that's why you're seeing London and places I expect as well, like Edinburgh, where you're going to see rents falling. And the predictions are anything from about 3 to 5%. So whatever you were renting it around 2014, you're probably looking at going back to those levels if you're having to re-let. Always makes me laugh. You would have seen stories about Sadiq Khan. He's just came out, the London mayor, and said, we need to freeze rents. And it's like, well, really? They're going to go down by 3 to 5%. Why would you even bother? So, as always, politicians not understanding what's actually happening on the ground. So that's the kind of rental forecast. Prices, you might think I'm hedging my bets here. So this is Kate forecast, and I'll explain why. So prices, I expect, will fall by anything from 0 to 20%. And
not 0 to 100%, Kate.
No, definitely. So I'll explain where the 20% comes from. So normally during a recession, prices have fallen both in the 2007 recession and the one in the 90s. They both fell in those times by 20%. So that's my kind of recessionary bottom line, typical how much prices will fall by, because some areas will go into a huge recession over the next 12 months. However, let's take a scenario of a street where I used to live, and properties hardly ever come up on that street. It's about 150, maybe even 200 properties on that street. Probably 2 properties come up for a year. And one of the things we don't focus on, I don't think, enough in property analysis is who buys, the occupations of people buying properties. Now, originally on this road when I was younger, because that's where I grew up, people that bought were teachers. And in fact, some of my old teachers are still living on this road, and they are definitely old. And now the new buyers are GPs or consultants at the hospital. So if only 1 or 2 properties come up for sale each year, and if they're going to be bought by a GP or a consultant, or somebody in food retailing, or senior management in one of the parcel delivery companies, the difference with this recession is that normally in a recession, everybody kind of suffers in some way, shape or form. But we have this really weird recession where some people are going to suffer badly, and some people are actually going to do quite well, or they're certainly not going to suffer at all. So where you have a real shortage of supply versus demand, even within this sort of COVID safe job sector, as I call it, then there's no reason for prices to fall at all. And that's partly a little bit about what we're seeing at the moment. People are seeing a property they love, they're in a good financial position, and they're going for it, and they don't care almost what price they pay. What they want to do is get in before the second wave strikes, albeit we're perhaps a little bit of a way there. So the point I kind of want to make really is that there's no point looking at averages at all. They are so misleading. And of course, all of the media information you'll get are on rents and on prices are on averages. Rents are a little different. They're a little bit more similar to the averages, but on property prices, you're investors, just forget it. You can get inflation information for property on the road that you're looking to buy or that you own. Why would you bother worrying about, whether price is going up or down by 10%? You shouldn't care. You should be better than that, if you like. And it's all about that property on the street. The other thing is, for those that are kind of predicting, and I think CBR came out and said, oh, prices are going to fall by 13, 14%. I think Bank of England has said 16%. Others are looking more at a 5 or 10%, typically in the property bracket. The only exception to that is quite interesting, Capital Economics, who are usually quite pessimistic about the property market. They're more saying the market's going to fall by 4%. So why, when we're going into a recession, may we not see in overall on those averages 20% falls? And the reason for that is, if we go and look at the market in 2007, we had stupid 120% lending, 6 or 7% high interest rates. You remember the city centre flats overpricing, and you can still see that now. We're selling properties for 30, 40% less in Nottingham because they were overpriced all that time ago. We had this horrendous subprime crisis, which we clearly don't have now, and it affected the whole economy, bar food retailers. So if you want to do a good thing as an investor, always target a property at somebody in food retailing, because they always do very well in a recession. So big top tip there. And also you can have a look. So how we put a roof over our head influences what happens to prices and what happens to rents. And in the rental market, it was just under 13%. Social was a lot bigger, but a lot of people, the rest, everybody else, so you're looking at nearly 70% of people there owned their property. And you're looking at nearly 3 times, well, you are looking at 3 times as many people had a property with a mortgage as they did with renting. And that's where things start getting different. So there are some lending restrictions, but mostly for those with only small deposits. But that's actually only a tiny part of the market. Most people are putting down quite high deposit. Mortgage rates are hardly anything, 2 or 3%. And they're also been fixing them for 5 years. So you're not going to get some of the shocks that you got in 2007 as a buyer. And bar London, we're not going into this on a huge high. So when we went in London, when it went into the 2007 recession, that prices have gone up the previous year by 17%. Whereas actually they were slightly down and maybe just slightly come up a little bit more this year, but not by that much. So you're not coming off a wave that then is crashing. And that's where, might be completely wrong, but that's where I'm not sure people are going to see the crash that investors and first-time buyers potentially always hope for. Lending liquidity. Lenders have got lots of money and it's affecting part of the economy. But here's the bit that's really interesting. You look at the rental market now. There's not the percentage of people renting versus the percentage of people who are going to be affected by the mortgage is not that different. So those are your averages, 20% of people renting, just under 30% own with a mortgage. Quite a lot of those are on low loan to values, so they've got big deposits, so they're not unlikely to be affected. And the government, I don't think, is going to let lenders kick people out of their mortgage properties. You've already seen the deferral come in, but how are they going to house them anywhere else cheaper than they're probably funding that mortgage? Because I doubt they can. And then you've got 20% of people in the rental market. And currently, the kind of government view is that landlords are going to pay for anybody who can't afford to live for the next 6 months based on the eviction side. So our structure of our market is completely different. Prices might still drop by 20% everywhere, but logically they shouldn't. If they do, it's a big lesson, it's a big learning for us, and I'm wrong, and I'm willing to accept that. But logically, they haven't. And the fact that we've had such high growth the last few months suggests that this probably isn't that far off. So the critical thing, of course, is what's happened to the economy. I've just kind of put charts up, but this basically tells you what's happening to, it's based on GDP, what's happening to economies, how fast they're growing, 2019, 2020, and forecast for 2021. China somehow seems to have got completely away with this, which is pretty cruel compared to the fact that it's kind of crashed the rest of the world left, right, and centre. But it is what it is. And in summary, really, what I'm saying is, so UK's not expected to underperform versus it is expected, sorry, that should say, versus the world in G20 countries. It's not a huge surprise. But versus the euro area, we're about the same. And the current belief is that next year is going to be tough for the first part, but we should start recovering to the end. I think that's mostly based on a vaccine. And my view is I reckon, though, based on everything so far, that we're going to be looking at 2022 before we see things getting back to anything like normal, whatever that might look for. The critical thing is, and we'll have data on this between now and Christmas, is what happens to unemployment. So this is a chart which basically looks at that claimant count. That's really what you're looking at. You see unemployment started to go down, it was pretty low, and then it started to rise. But that claimant count has gone up dramatically, and that's clearly people losing their jobs at the start of COVID and moving in. And that's what all the lenders are absolutely paranoid about, and why they won't be too generous, and why, Nicholas, you're probably having a few problems because their due diligence is kind of going through this roof at the moment. And when you look at past recessions, what we've seen is the unemployment rates haven't been as bad as they were in the past. You look at 12% in the past, 10%. We looked at about 7 or 8% in the last recession. Now the forecast has come down a lot, so you're looking at around a 7-8%, so similar unemployment to 2007 levels. However, I'll tell you now, there are some predictions that it could be double that. So, and nobody's got a clue. We actually have no idea, and it's unemployment that's going to decide whether you have some fantastic bargains to buy next year, whether you have some massive problems getting your rent in, or whether we'll just kind of slide through a little bit like we have, if it's not as bad as previously predicted. And the key thing, I think, from an investor and from a landlord's perspective, is who is being made unemployment. And landlords, you need to take note of this, because most of the people are in hospitality, catering, those kind of industries. And in my view, most of the unemployment is going to hit the rental sector, not the homeowners as bad. As I said, some areas would be worse than others. So if you imagine an area that's got a massive food retailer, or head office there, and I don't know, say somewhere like Wakefield, and then the other big employer is the hospital, you'll probably do fine. But if you're on a coastal area and everything is catering and hospitality, you're probably going to have a really tough time, and you need to be aware of that. And the other thing to be aware of is that actually the beauty of property is that even if you haven't got anybody in areas to rent to, of course, due to the lack of social housing, the government has got to put people somewhere. The difficulty at the moment is they've decided landlords through the eviction side are going to pay for anybody really that can't afford their rent over the next 6 months, whereas we're calling for tenant loans to try and make life a little bit easier and to be fairer on yourselves. So the other thing that was quite interesting that I came across was that I looked at different brackets, and this chart basically says that whether you're earning 55,000 or less than 20,000, everybody's kind of suffering. So it depends on how they house themselves. Most of those people earning 55,000, I expect, have low loan to values. 50% of people, remember, own their property outright. They have no mortgage. So as long as they have some income come in, they're not going to be forced to sell. And I think that the other thing to bear in mind is that the one area that's the safest almost to rent to at the moment, or target, is actually people on universal credit, because they've had £1,000 wage rise, and they are less likely, for example, or they're not going to be likely to be furloughed like other private tenants. So for any of you kind of avoided that sector in the past, obviously you can't discriminate, but you need to open up your hearts to that next year, and potentially start working with your local authorities. So that's really important. Is the UK still a good investment? Yes, it is, and it always will be. So trust me, everybody else around the world is going, oh, right, okay, you've got a bit of a bump in the road. Let's come into the UK, because it's seen as a very, very safe investment. If you're in South Africa, Brazil, all of these other places, this is safe, and properties your 20-30 year kind of investment. So for me, what I'd look at is it's definitely a time to reevaluate your portfolio. Make sure you're probably going to have a 12-month rental emergency pot. There's definitely something coming through, and this started in the last recession. Houses may well be a better bet than flats. universal credit, as I mentioned, better. Be careful on HMOs. And Nicholas, you probably comment on this better than I, but some of them are really getting oversupplied in areas. So you've got to really make yours stand out. And bearing in mind that the student market, it may still collapse. It's kind of done very well, but it may still not do so well depending on what happens over the next few months. I'm not sure that I would want to have a portfolio that's specialised in an area. Just thinking for the future. So you might want to have a little bit of think about that. We mentioned sort of ways to make money, opportunities. There'll definitely be some bargains next year. Some areas are actually falling now. The Northeast just has never recovered from 2007. So it's a good opportunity, but you've got to really know that market like your back of your hand to make money there. We've got the new government rules, and there's definitely opportunities commercial for resi. Nicholas knows far more about that than I do. For me, build to rent or build to sell, those are by far the best investments. You can build in your own capital growth when it's not going to be there, and in fact prices will fall. And your local authority may well be your best bet for your next tenant. And for me, really, sort of last tip is just be agile. And don't just think that what you've done in the past is going to work for the future, because actually it may well not. And it would be a shame if you've been doing this for 25 years really successfully not to take stock now, rethink what you're doing, and make sure it's going to be right for the next 10, 20 years. So there we go. That's my joy.
Amazing. Thank you, Kate. Very, very insightful. That's certainly going to spur some conversation for the rest of the chat. We've got lots of questions in anyway, and although you've probably covered some of those bits, let's go through a few of the questions as we come along. If you guys have enjoyed this segment so far, you've enjoyed Kate's insights to the property market, please do subscribe to the channel at the moment. It's really important that you subscribe, hit the bell icon. If you don't do that, you won't get notified. We had a little issue this morning where we didn't connect to the set up live stream. It just started streaming separately. Always technical issues here. Still learning as we're getting to the new technical era after COVID, for goodness sake. But well, it's always a challenge. No matter what you do, something goes wrong. But we continue to push on. And thanks for most people who have jumped across. We've got quite a few people on. So make sure you subscribe. You would have got a notification, then you'd have been straight on the live stream. So I see some people subscribing as we speak. So do it as we speak, guys. Subscribe, bell icon, and you'll be able to see the next instalment. We're doing these chat shows kind of every other week or every week sometimes. And Kate and I get together every couple of months as well to do these kind of things. So really good content. You don't want to miss it. If you've got the questions, keep them coming in. We've had about 5 or 6 questions come in on the live chat. I want to see more than that. We've had 20 or 30 come in on the pre-registration. So we'll fall back to those if we have to, but we want to prioritise anyone that's on live, and we can then get a bit of interactivity going. So I guess going back to house prices in 2021, what people want to know as investors is what should they be buying? I mean, you touched upon a few things there, and I think critically you touched upon it's critical where you buy firstly, isn't it? It's not necessarily what you buy. You don't want to be buying in a falling area or an area that hasn't got that demand. So maybe refocusing your strategy. If you're in an area that's falling, you might have to go a bit further, right? I guess that's the message there.
I mean, it's one of those things. One of the things I love about property is you can always find a deal if you like, but what you've got to bear in mind is that, and it's a tough job, you're buying now to make money potentially in the next 25 years.
That's the tough part,
or
isn't it?
I mean, if you're buying now and you're looking at flipping, you've got to really really know your stuff to try and do that.
I wouldn't say that. You've got to be a gambler.
Yeah, absolutely. And you are gambling, so make sure you have a backup strategy, and don't forget that could affect your tax as well. So really important to get your tax sorted before you go into it. So there'll definitely be, the beauty is there'll be some bargains next year. Without doubt, there just have to be. You may well have to wait till the end of March, just so as you know in the background, because this is the sort of stuff you wouldn't necessarily pick up. We are in discussions as an industry as to whether this cliff edge of the 31st of March is a good idea or not. For the simple reason, if the industry is at capacity now, we're not sure actually it could cope with extra sales or the push that you normally see before the end of a stamp duty. So whether that will change or not, don't assume that's set in stone, because that may change, because as I say, I'm not sure the industry can cope, so it might not be the best idea to do it. So what I would say is you've really got to understand your local area. Your demand is population. And one of the reasons why the Northeast hasn't done so well and won't do well on prices and rents moving forward is simply because they have a really good supply and demand match. They don't have a rapidly expanding economy, so people aren't earning lots more money, and as a result, people can't pay more. So that's why in the north, it doesn't mean you can't buy a property and make money out of it through capital growth in the northeast, but you've got to find that particular road and go and research the last 20 years. I personally don't like leaving it up to other people. I'd want to do it myself. The data's free of charge. It's sitting on the land registry and all the other portals. So you've really got to kind of do your due diligence, but you can find out the price inflation over the last 20 years for a property on a street. Why wouldn't you do that? So I think it's really about then coming back from that and going, what's your objective? Is it capital growth or is it income? Because the other thing we've found, and this definitely has happened since the last recession, is you either get roads that are good capital growth or good yields. Only way you can get both is build to rent or get a cracking deal on a good capital growth road, if you like. It's the only way to do it. So it's all about the individual. So I've said HMOs aren't likely to do very well over the next few years because of oversupply. But I bet you there's a road somewhere where somebody's desperate for an HMO and where you can have one. So that's what you've got to really consider is that supply and demand and people's affordability and the local economy's likelihood of driving forward, and if those jobs in that area are COVID safe.
Yeah, definitely. I think the thing with HMOs is that you've got to make sure there's the demand there. And what, one of our viewers here has mentioned, thank you, Steph. She said, don't forget the fringes of London areas such as Reading, that's where we're based as well. There's a strong commuter belt and tenants are returning to their families' homes rather than renting. So that's kind of like, what we're seeing in Reading and surrounding areas. We're seeing these people that might rent Monday to Friday in an HMO or in a studio or in a cheaper unit, they're moving back to their family homes and working from home. So you're kind of losing those kind of tenants as well.
Yeah.
Combined
And
with
that's
kind of
where
student
people have
properties.
got to be clever about their portfolio. Reading's a
Yeah.
cracking area. I owned a flat there and did very nicely out of that. So it's a good area, but now you've got to reevaluate the supply and demand of what you're offering.
Yeah, absolutely. And, if you have to manage your, property better, if you have to upgrade it, it's going to be those that are the better landlords, I think, that come out of this, the people that market themselves better, that set their sites up better, that manage them, look after their tenants better, give a better service, then you're going to, be better placed. There's things that's what I like about property is there's things you can control. Obviously if you're down on a coastal town and you're, doing short-term lets to all the workers, you're gonna really struggle. Doesn't matter how good you are,
Yeah.
there's just not going to be the people. But in other towns where there is still an underlying demand, you can still differentiate yourself in whatever area you're in, whether it's HMOs, anything, or just single buy-to-lets or whatever. You can still make a difference, can't you? I think now's the time
Yeah,
to
absolutely.
up your game.
Yeah, absolutely. And it is just that getting that understanding and knowledge. And sometimes I think we're still guilty in the property investment area of just assuming you can buy any property on any street and it'll make money. And actually, that hasn't been happening since 2005 in most places. So
No.
we need to update ourselves after to the changes that we've seen over the last 15 years.
Absolutely do. I've got a question here. This one I'll have a crack at first from Charles Hargreaves. It's a pre-registered question. Thanks, Charles. Appreciate that. Will there be a move to rural houses with dedicated working from home space and outdoor space? Well, that's a good question. In my view, yes. I mean, it can't hurt, can it, Kate? I mean, we've got units where we, if whether it's HMOs or build to rent, we try and give some communal space. And, our build to rent stuff's got good space for each individual anyway. So we kind of cover that off. And in our latest site in Newbury, we've got lovely big balconies out on the top floors. So a third of the building's got this outdoor space for every person. And being in good locations, we tend to pick town centre locations. That is their outdoor space as well. Of course, it's more town centre living. So I think we try and do that anyway. And I think people are going to be more aware of that. So if you're looking to buy, surely, looking for kind of COVID friendly places with gardens and outdoor space is going to be on the agenda, isn't it?
Yeah, and we're definitely seeing and have seen and continue to see both in the homeowner and the rental market a shift to houses. So certainly in the rental market, most of the shortages in supply are in the housing, our houses. What I would say is we just need to probably wait another 6 months or a year to find out exactly how this is going to settle down. So
Yeah.
I wouldn't 100% believe. Sorry, my Dalmatian's coming to join me. He gets a bit lonely sometimes. You need to say hello.
Wizard.
There he is. He's going. Where's Nicholas? I haven't had my morning kiss.
Oh,
So
he's a gorgeous dog.
so sometimes people get overexcited that everybody's going to move to a rural area, etc. And normally what happens is, yes, that does happen, but nowhere near to the extent that everybody thinks. So I'd caution kind of about jumping too soon. But what I always say is just remember a property is a box. And you need to make that box as flexible as possible. So I think about, I was touring the country doing a load of presentations on maximising buy-to-let for Belvoir. And we were doing individual towns. So go to Aberdeen or Ipswich and Southampton, right over to Cockham, areas like Cockermouth. And they're all very individual. But the one thing that came out about that actually was 3-bed houses were probably one of the best investments. And I'm sort of saying this 6-7 years ago, and this is working out about right. But the reason I like them is you could turn them into mini HMOs if you need, but you can also sell them to the generation that are trading down from those lovely 4 or 5-bed houses, who have got the cash, made all the money, and you're most likely to sell your property at a higher rate there. So it is about looking at that property and looking at it a box. So if there's clever ways, and you don't necessarily need it to be rooms, but clever ways of designing desks and stuff like that. And there's loads of amazing stuff you can see online about beds becoming desks and all sorts of stuff. That it's a clever use of space, I would do, rather than worrying too much about. So as long as you've got a room where it can be a flexible space, so when bedrooms are needed, it can be a bedroom. When offices are needed, it can be an
Yeah.
office, etc. That's the trick to property investment, and certainly over the long term is making sure that it's that. Think of it as that flexible box that you can turn to any tenant, you can turn to any buyer, and therefore make the money that you need.
Yeah, definitely. And you touched upon people moving out there. Before discussing the sort of space design, which when we create our studios, we're always very cautious to get the space design absolutely perfect, as best as we can with the buildings we're working with. But David Lockett's asked a question. I've just brought it up on screen here that he's saying there are conflicting reports on the number of people moving from cities to rural areas. Have we got any views on that? So is that just misreporting, Kate? I mean, you're probably.
I think it's just too early to say, because
So it's more predictions and.
yeah, I think it is just too early to say. So there will be some movement, but my view is if you're, for example, in London and you've got this opportunity to work from home, normally what they've been talking about is shifting out to the home counties. But I'm sitting here, I'm an hour and a half from London, and it's just cheap as chips where I am. It's halfway between Grantham and Newark. We're on the east coastline, and I can commute at the same level as most people can from the home counties.
Right.
And therefore, where people are going to end up, we don't know. And also because some companies haven't, I don't think the businesses have really understood what their commercial strategy has been. The only big hint we've had, which could cause people moving out more, is the likes of Schroders in Canary Wharf that has basically turned around and said, right, guys, do whatever you want. As long as you can come into the office at some point, that's fine. That's a big deal. If HSBC, if Barclays, if all these big companies go out and do the same, that's fine, but they're probably not going to be doing that till January, February next year. And then we're going to have to wait and see. And I can't see, why would you move out of kind of zone 3 or 4 in London and go to the home counties where it's as expensive, if not more in some cases, rather than jump to Wales or jump to Scotland or wherever, or up here in
Yeah.
near
Okay.
Grantham. So I would take them with a bit of a pinch of salt, because you've got to bear in mind that the agenda behind a lot of these things is to get your name in lights in the newspapers. So without wanting to be hypercritical
Well, the
or
newspapers do
cynical.
post whatever they want to sell a newspaper, don't they? So it could be
Yeah,
absolute
and just
rubbish.
on that, to give you an example of how bad it is I remember, I mean, you think of where we are now price wise. I remember front page, headlines on house prices fall the most in 8 years. That was
Yeah.
based on a 0.1% fall year on year. It's like, come on, that should never, ever have, they accuse the property industry of being scallies. Well, that was a horror. So
That's a good one.
I'm really wary of these. I read them, take them with a bit of pinch of salt, but I'm going to be
Yeah.
waiting until January, February next year to believe it with my own eyes.
Well, I think that's why it's really, valuable that we're kind of out here doing these shows and stuff, because it's looking at the analytical data. People make up their own mind. We're not going to tell people what is going to happen. We don't have a crystal ball, but we can look at the data, we can analyze it, and we can give probably a bit more of a realistic guess than the papers. That's the key, isn't it? To keep an eye on this.
I'd like to think so.
Absolutely, definitely. Sorry, no, I wasn't sort of downplaying your incredible stats.
No, I wasn't. Kate. I'd be like horrified if I couldn't outperform the newspaper headlines.
Yeah, I was going to say, yeah,
because they're so
I'd
bad.
definitely be betting on you.
So bad.
I'd be betting. Right, so Jeff Spires has asked, and again, guys, thanks for your comments there, David, on that question. Appreciate that. He said, thank you. Good answer. Time will tell. Jeff Spires, pre-registered question here. Thanks for this, Jeff. Is it a good time to buy a unit in a care home? And is it a good time to buy loan notes? Well, on the loan note question, I can answer that. From my opinion, we do loan notes with our company, Red Brick. So if there's any hands-off investors out there, we'd love to hear from you and tell you what we're doing. The key to that kind of product, and again, a unit in a care home, with any investment like this, you've got to check that it is compliant. You've got to check it's not a collective investment scheme. You've got to check the underlying developer and what they're doing, what their business model is, and how they are coping now, and how they've coped over the last few years. How established are they? What's their track record? With any investment that is slightly hands-off, as these two examples are, it's all about the operator and the developer, their ethics, their track record, what they've done, and their ability to deliver projects on time and on budget. So I'd say it's all about due diligence, really, with that for me. Have you got anything to add to that one, Kate?
No, not really.
Hands-off stuff,
a great
really.
answer. And to be honest, what I would say is I've seen a lot of these go very, very wrong for people. So one of the questions that I get asked most is, how do I get out of these kind of things where people haven't done the due diligence? And I would suggest, you really find somebody that's a good accountant to go through the numbers, who's got experience in this area. I've seen that. Do you remember that? So there's a lot of kind of student schemes or care home schemes, etc. And the difficulty you've got with those is, how do you sell them on? And who do you sell
it's
them
a unit,
to?
isn't it? And it's not like a flat.
No, exactly. So I'll give you an example of that I'm thinking of is, I'm looking at all those properties that everybody bought when they had loads of money in Spain.
Yeah.
And I'm like, when they're passed on to the kids aren't going to be able to keep those properties, and they'll want to sell them. Well, who are they going to sell them to? Because the British and everybody and the Irish and everybody else aren't buying anything like the rate they were. So my advice when people were buying in Spain was always, if you're going to spend 60, 70, 100,000 pounds on something, just check that versus the costs of hiring somewhere for a month or 2 or 3 months during the year, each year, where you can pretty much get a good relationship with the owner, and they still worry about all the repairs and everything, or indeed what it would cost to stay at a hotel, because that's what you're going to be doing over there. And then I think that the kind of next worry for me is what happens to those in the next 10 or 15 years.
I mean, for me, holiday homes are something that, when we're not that experienced at property investing, we sort of dream of as younger adults, and we think, I want this holiday home as a second home. And it's not all it's cracked up to be. A lot of people I speak to, it's a maintenance nightmare. And what happens is they go on their holiday there for a month a year. As soon as they get there, they've got 2 weeks worth of work for maintenance, keeping the thing up to date and painting it and paying someone to come in and fix this and fix that. And it's just, properties are a liability. Unless, like you said, they're a box that makes you money, they're a liability, and they will cost you money. Unless you're renting it out, Airbnb-ing it, and you're treating it as a proper business, then that's valid. If you've got a proper strategy, great. But a holiday home, I'm not a buyer. I've not got a holiday home. I never would buy one.
I've looked at it so many times, and I could never make the numbers work.
No, not a good one. Right, so moving on, let's have a look at some more questions that are coming in. Oh, David M has asked, well, he's not asked the question, but we can comment on it. There's also predictions about people wanting to live closer to their workplaces to avoid the commute altogether. What do you think about that
Yeah,
one?
well, I like that
Good
one,
theory.
and you can kind of see why people would want to be in that situation, and that's a classic example of why I'm not sure that we should kind of listen to all the stuff that's being talked about at the moment, because this is what's happened over the last 6 months is the biggest sort of cultural and economic shake-up, not just to our country, but to the world, that we've ever had. And it is, I believe, going to completely change our way of life. But we're not going to know how much it's going to hit us. We're still slap bang in the middle of this thing. And we might find, if there's a vaccine comes in, I don't know if Boris is going to get us one for Christmas or Easter. I
Be a
think
nice Christmas present, wouldn't it?
maybe come the Easter bunny injection or something like that. But when that comes, people might just actually be desperate to get back to their old lives. I don't think they will, but this is really shaken people. It is going to change stuff. And if you're a developer right now, it's a pretty tough call as to what happens in the future. But I can see people wanting to move nearer to work, exactly that, so that they don't have the commute. You can see people moving out of big cities. I mean, I don't know if there's anybody, I'd be really interested to hear this, but a friend of mine was in London and they just said it was dead. There was no atmosphere. All of the kind of fun of London had gone out of it. Now that's one person's view, so I'd be fascinated to see what other people are saying. But maybe if the froth of London living, and I enjoyed it when I was younger, has gone, then that could be a game changer. So and it could be a positive game changer though, because if companies do decide not to have the offices they have, maybe this COVID could help us solve the whole of the housing crisis over the next 5 years.
Yeah.
In which case, people can live where they want and work where they want. Um, but we've got a good 6 months, if not a year, to go, I think, before we can come to any conclusions. And I'd say ask as many people locally, because different localities will react very differently, I think.
Yeah, and
So
London, I mean, you've touched upon London specifically there. And for me, London's always been, as the stats will prove, that, the first to fall and the first to rise usually after any sort of recession period. It's the riskiest, most volatile market, but then it's got the most capital growth potential if you buy at the right time. At the moment, the question is London a better place because it's not crazy busy like it was?
yeah,
I think the tourists will come back, which will make it feel busier. That's
I agree.
potentially why it's a bit dead now. I think people living there, it might make it a bit more affordable for people to live there, and then it sort of comes back.
Without a doubt, and going back to the presentation, London is not going into this recession with that huge rise that it had in the last two recessions. And in actual fact, the forecast, so Savills forecast was the most interesting. So this is pre-COVID. The expectation was over a 5-year period. So not each year, over a 5-year period, prices would rise by only 4%. Now, Londoners are used to 5, 6, 7% growth each year. And the reason for that was because it had topped out affordability wise, because the government's put the first cap on house prices, which affects London because of the mortgage lending restrictions of being able to, how much you can lend at 4.5 times income, and because of the interest rate. So you don't get measured on today's interest rate, you get measured on a longer term interest rate. So London wasn't, from a capital growth perspective, looking to have its worst 5 years ever. Now, I always thought that was a bit low. There were other predictions for 10 to 12%, and I felt they were more correct. But that's probably looking about right now, to be fair to Savills.
Yeah, it's a tricky one, isn't it? I mean, yeah, my kind of opinion on where people are going to go, I think, again, good solid towns of a decent size. If you're looking to invest, not necessarily London at the moment, it's too risky. But good solid towns, people have got to live somewhere, right? Not everyone's going to move to Wales for the quiet life. I don't think that's going to
Yes, I
happen.
agree.
People want to be in the buzz. So, if you're investing in buy to let or any other form of investment, pick your areas carefully, but pick good transport links, maybe good transport links into London. We operate in the Thames Valley, which has got excellent transport links and Crossrail. And I actually firmly think that, build to rent is stronger than it's ever been, and that's
Absolutely.
thankfully the sector we're in. Touch wood, as we can't
Good
predict,
call.
but we're adding our own value when we build. And I think you mentioned that earlier. You
Yes.
can add your own
Yeah,
value. You don't need the
absolutely.
market to do anything.
Big fan. Yeah. I tell
That
you
helps
one thing
counteract.
to go and watch if you haven't watched, because you can watch it on iPlayer, was Manktopia. Did you see that?
I did
It was
actually. Yeah,
about the
yeah,
urban regeneration of Manchester, and it was absolutely fascinating. If you really want to, I kind of look at Manchester and think, oh, I'm not sure. I didn't appreciate how much money was going in to
yeah.
Manchester, but I still wonder if the money's already been made there. But there are going to be, what it'll do is it'll allow pockets. So there'll be these nuggets of houses somewhere in and around Manchester, which are probably
Mini districts. Yeah,
or little roads that you just never thought of. So when I bought in London, I always used to buy on the edge of an expensive area. So I bought in
exactly.
Acton,
That's exactly what we do. Yeah,
where you've got Chiswick or you've got Ealing, but you've got a 30-40% reduction in price. And looking at taking that strategy to Manchester, I'd definitely go house, not flat. And there's also pockets in Birmingham. But what you've got to remember with both of those cities is they've still got plenty of places to build. Nottingham's supposed to be a buy-to-let hotspot. We can build as much as we like in Nottingham because there's tons of space. And that's the bit everybody, I don't always think through necessarily. If you're certainly coming out of investing in London, doesn't think through the supply and demand factor.
definitely. Moving on to a question now from Geordie Jancy. Thanks, Geordie. As an investor, what do you think about the commercial industry, such as retail? Will banks change their appetite on lending? People working from home and people buying online instead of shopping out. What's
Oh,
your
it's a good
thoughts on
question.
retail?
Yeah, I'm not a massive. I'll be honest with you. I'm very straight about what my strengths are. My strengths are definitely in the residential sector in the UK. That's what I talk about. But the commercial market, we've done some, and we look at the mixed use on commercials. So what I would suggest, and this is just my experience, so please go find somebody else who's much better on the retailing side. I think because you've got your main shopping centres, and then you've got your second tier and etc. And that stuff is very important to understand. So there's a lot in commercial. For me, what I would probably say is if you are going to look to stay in the commercial, and it's quite a brave decision potentially at the moment, I'd have my backup plans of how can you buy mixed use? So can you buy something that would give you some resi income? Or if you buy it, could you convert it into resi?
Yeah, yeah.
So I'm not best placed to advise you on the kind of lending side and that, but certainly as a caveat, those are the two things that I think if you have those in your back pocket and the ability to do that, it might be worth having a chat to the local planners and see how they feel about it beforehand. That's the kind of route I would be going. So
I
apologies, I
agree.
can't give a better answer than that.
Multiple exits, isn't it? Multiple exit options, and with these residential PD changes coming out, already we moved in September to this new Class E, which sort of lumped
Yeah,
together all the retail shops, D1s, all these kind of retail style planning classes, and I think that's possibly going to be followed with more permitted development changes around that kind of stuff next July or sooner.
yeah,
And it'll be interesting to see, splitting
yeah,
up shops to make them
and
smaller,
just to
maybe.
highlight, the new space standards have come out. I don't know if you've seen that. I'm guessing
I did
that's
see that. I mean, that kind of is a bit frustrating from our micro studios, but we build decent micro studios, not
yeah,
10 square meter micro studios. We built a 20 to 25 square meter, well, up to 30 square meter studios, which I feel is the lowest you want to be going for, good, comfortable studio. But, with what they're trying to cut out is the people building 12 to 15 square meter
yeah,
studios
absolutely.
and sticking in, terrible, tenants and
Yeah, the
creating these
cheap
ghettos.
conversions, basically, weren't they? Cheap, bad quality conversions,
Terrible
typically.
quality, yeah.
Yeah, yeah. So if it wipes out them, then all for the better. But again, one of the things you have to accept as an investor is, boy, have you got to be on your toes, and doing things
Yeah.
like this, and signing up to these broadcasts is so important because it's a hell of a thing to try and keep up with.
Yeah.
There's new
Yeah.
stuff coming out every day. I mean, on the evictions for landlords, I remember putting all our stuff to bed for our clients on the Friday and feeling very happy with myself, planned to take the next week off. And blow me, they came out and completely changed the rules. So I had to spend my week off redoing everything. I'm still not over it yet, if I'm honest. I've tried 3 times to have a week off, and every time the government's like punctured it. So
They
I
know
haven't.
you're trying to have a break.
Yeah, I haven't forgiven them, but I was really angry, furious about the eviction side because it was such a sea change. And then, of course, they drip fed information for the next 3 weeks, and you only had to, I was going to say catch a cold, but under the circumstances, you only had to be ill for a couple of days, and you'd miss the space standards, or you'd miss the eviction changes, or whatever. It's a heck of a thing to try and keep up with. It's really testing me at the moment.
Yeah, I think that's one of my main complaints is how the information's been disseminated to the public. I mean, even these PD rights yesterday, they've not released when those will be implemented. If you've bought, a 10,000 square foot office for a couple of £1 million or more, are you now screwed, for want of a
Obliged,
better
yeah.
phrase? If you bought that for a
I
resi
get that.
conversion, you were doing a micro studio scheme or something else, are you now going to go bankrupt? Because a big
Yeah,
site like that would bankrupt a small to medium sized developer.
yeah,
So it's
because the
just
margins are
terrible the
so
way that
small.
they're sort of chucking this stuff out
Yeah.
there, not following up on it.
Yeah, I mean, to be fair, it does depend who you deal with as well in the government, because we have lovely people who deal with the PRS on the MHCLG, but we're not getting anything through. It's like banging our heads against a brick wall. Go on to the home moving side and changing the home moving market, and fantastic, great working relationship. You can see all the things they've done for stamp duty and opening up the market early, allowing us to continue during lockdowns, etc. Which was a bit of a worry, but thank goodness that's gone through. And hopefully, even if we have another lockdown, I'm saying, look, you can't, bearing in mind COVID increases death, divorce, and debt, which is the biggest reason people move. We think we've done a pretty good job as an industry at keeping COVID at bay, and doing everything we can not to be a cause of spreading the virus as an industry. So even if we do have another lockdown, I'm doing what we can to keep our market open. But that does also require landlords, tenants, property investors to abide by the rules. So just a heads up, the more you abide by the rules of opening windows, hand sanitizing, face masks, all of that kind of thing when you're doing viewings, the more likely we are that we'll have a chance of staying open, even if we hit another lockdown. And I think that's right for consumers, and I think it would be good for the industry if we could keep going.
Yeah, I agree with that completely. It's better safe than sorry in any
Yeah,
event, and prepare early, prepare for the worst, and hope for the best. I think that's a good way
absolutely.
to treat any business, isn't
Yeah,
it?
yeah, especially at the moment. There you go,
And
0 to 20% price falls.
0 to 100% price falls. Yeah, exactly. We've got a couple more questions here. Actually, this is an interesting one. I don't know what your experience is, Kate, of the Scottish property market, but he's asked, have you got any predictions for the Scottish property market in 2021? That's Andy Watson. Thanks for that, Andy. That's a pre-registered question. Any questions, put them in the chat, by the way, guys. Before Kate answers that one, please put them in the chat. Any more, guys? Coming up to an hour mark, so we're going to start to wind down now. But if you've got any questions, get them in, please. And don't forget to subscribe. There's lots of people still live here, over 50, 60 people still on. We've had, I think, well over 100 people live on just YouTube, and there's multiple channels as well. So do subscribe, get the bell icon hit, and you'll be able to see Kate and I probably in a month or two as well, having another chat and see what on earth has gone on in the next couple of months. But Scottish
Yeah,
market,
you
Kate,
can tell me I was
any
talking a
predictions
load of
there?
rubbish.
Yeah, you can hear us waffle on about a load of rubbish. Well, get yourself a
Yeah,
cup of
so
coffee next time. You've not had a drink. I've got my coffee here.
oh
Keep
no,
me going.
it's been a bit of a busy morning, so I haven't had much chance for that. Anyway, it's Thursday lunches now. I might be having a bit of fizz by now.
Yeah.
If I wasn't on here. Um, Scottish market is really interesting. So I was very lucky. My first job, albeit not in property, was to tour Scotland for retailers. Actually, basically, forget Scotland. There's like four massive areas, of which are Edinburgh, Glasgow. You've got the likes of Inverness and Aberdeen. So take the Aberdeen market, and that's one of the most fascinating markets that we've seen over the last probably 15 years. The reason being is that back in the last recession, the Aberdeen market hardly took a hit. Hardly took a hit on prices when we were like going, oh my word, the world's falling in, rents are falling, prices are falling. They hardly took a hit. And the same on the rental market. And the reason being was because the oil economy was remained strong. Took a bit of a hit, but overall, their local economy was successful. roll forward, of course, when oil prices starting to crash, and not just crash as short term, but for a long term, they've seen massive price falls and massive rental falls. A lot of tenant groups will tell you rents never fall. That's absolute rubbish. They've looked at some areas, I think they've seen 30% falls in rents and up to 20% falls in prices in Aberdeen. So my assessment is that's still going on. The best data there is you can get it from the Land Registry, and we do produce it on Property Check This every month. But is actually city lets. If you look at their rental data and you're into that market, their city let data is fantastic, and it will tell you what's happening everywhere. So you've got, when I say look at each individual property on a street, that is so true of Scotland, probably more so even than some of the parts of England. So Aberdeen's got the issue of its local economy being shot to pieces for oil, and now you've got the impact of COVID. Edinburgh is going to be in a similar situation, I would imagine, to London. I haven't checked the data, but I'll have a look at this and do something on. Sorry for the shake. Dog had a shake. Laptop had a shake. So in Edinburgh, you're going to have the same problem of the oversupply coming in on the rental market, because there's a lot of short-term accommodation. You just think we just come out of we would normally have had the Edinburgh festival, massive, most of Edinburgh's turned into a rental market then. Probably Glasgow, there'll be pretty deprived parts of Glasgow and pretty expensive, and they'll be kind of doing okay. And out of interest, just to show you how different it is in Edinburgh, you take somewhere like Trinity, which is like the South Kensington of there. That market has been rampant. I mean, it's hugely expensive. It's like £700,000-900,000 for property, but they are absolutely gorgeous. But that market has been mad all year. The only time it slowed down was during lockdown, and it's still going rampant now. So it's a long answer to the question, but you've got to consider there isn't a Scotland. There's 4 or 5 very, very different markets, and you've got to go street by street, property by property, and look at those local economics. Because if you're looking at Aberdeen and you want some bargains, and you're looking at a 20-30 year, then Aberdeen may be quite good. Edinburgh's always had the strength. But I'll tell you a funny stat for Edinburgh. It's something like, and I haven't been able to source it again since, but I'm pretty sure that in 999 years' time, Edinburgh will be empty. And that's because they have a really low birth rate.
Right. So basically,
you've got to look at
dying out. They're going to be extinct.
Absolutely. And it does happen when you look at history. But population, economy, how's it going to sit on the COVID safe factor? Is it vulnerable or not? Road by road, look at rents, look at prices. That's your kind of success formula moving forward, whether you're reviewing a portfolio that you have now, assessing a development for the future, or indeed looking to get into the property investment world. It's good, and it's nice when you look at those stats, because you feel more confident, and then you can get your plan B and plan C pulled together as well. Essential at the moment.
I think that's good advice. I mean, that's good advice for any area, isn't it? But more so for Scotland, by the sounds of it.
Huge.
You know, it's kind of London versus the rest of the UK, but up there, the cities are that much more defined.
Yeah,
in terms
absolutely.
of investment,
and that's why
performance.
I could tell you that I don't know. I mean, so property price-wise, I don't think it's even grown by about 1% on average a year as you go up. But some areas have done really well, and some areas haven't. So to turn around and say, "Oh, well, I expect prices to grow by X% in Scotland," it's the most useless statistic I could give you. So I'm not going to do it.
No, okay. And Client Investors is their name. Said St Andrews, he or she gets the same rate as their London properties with strong demand. So there you go.
Yeah, that makes sense.
Let's talk about
by the way, St Andrews.
Russ Hargreaves has put in a question. So Russ, thank you for your question. Online questions are being prioritised. The last few minutes before we sort of start to wrap up now. We don't want to waffle on. We've been accused of waffling on in the chat. Sorry about that, guys. We like a good waffle, but we're trying to get some good content out as well. Russ has asked, he said, watch out for valuers. They're very cautious at the moment. That's a good point. I mean, how do you feel about valuers, Kate? I mean, I think they're being cautious. I think we just had a little bit of a down valuation on one of our purchases on the rent, not the actual price, because clearly at the moment the prices have been quite buoyant, but they downvalued the rent level slightly, and that affected the loan to value. So something to be aware of there is the rent side of it.
Surveyors are in quite a tough situation at this moment in time, and they certainly
I wouldn't want to be a valuer.
No, and particularly because again, what you don't see behind the scenes is what's happening with professional indemnity. prices and stuff like that. So they are having to pay thousands and thousands and thousands of pounds for their professional indemnity. And it's not even, for some, value is the same in the legal profession as well. It's really hard to try and get hold of it. So, and the more uncertainty and difficulty there is, the harder that is. So they have a tough job at this moment in time. But all you can do as a valuer is look at what's happening around you. By the rules of, certainly as a valuer for RICS, what you can't do is say what you think is going to happen in the future and then value it according to that. You have to do it according to Red Book, I think it is, and you have to make your value, and it has to be fair, etc. So where we might think people are kind of down valuing, it'll be because they have to have, and if you haven't got it, they have to have the evidence for that to say that that's what the market is doing. They can't, my understanding is they can't kind of down value because of what they think is going to happen.
What they think is going to happen, no.
So it's what is that value of that property on that day. Now,
with
said
evidence,
that,
they need comparable evidence, don't they? Ultimately,
yeah, they do, and it doesn't stop the lender. I mean, I was quite surprised. Somebody bought a property in May. They did. It was pretty. You could see that value, and that was fair and everything. But the lender revised their offer, and it wasn't. I don't think that was based. So you've got a different thing there of the value of doing it, and then what the lender's willing to lend. So how much of it is the lender's down valuing, if you like, and how much of it is actually
you never know, do they?
Values, because in theory, really, as a valuer, you can't down value because it has to be the value of that day. Do you know what I mean?
Yeah.
So,
but they do.
They have to.
They do, and they're also putting in.
I think surveyors might be getting a bit uppity at this point.
Well, they're also putting in these COVID clauses, and Will Spencer, thanks for your comments there. Will, thanks for your questions today and helping the chat. They are putting these kind of caveats, aren't they? Which basically sort of makes their whole opinion redundant.
Well, no, to be fair, so that comes down to, you have to remember the practicalities and the situation that they're in. Those are having to be put in because of so they're recommended. So there's been caveats come out from a new terms to put in from the legal side, and they've tried to agree them all together. So we did that right at the start of the lockdown. We got legal things that could be put into contracts, because whether you have COVID or not, if you've exchanged and you don't complete because of COVID, for example, you're on the hook for the deposit. So COVID clauses were put in for them, and and on the valuation side, you've got to remember that their professional indemnity guys are sitting behind that, and it is a difficult job. So it's one of those things. So they're having to do it to protect their profession, really, more than anything else. It's not it shouldn't be seen as a hide behind. They just kind of haven't got much choice. They were hit very hard. Some of them rightly, I have to say. When you see some of those city centre flat valuations that we had in the past, some of them are hit quite hard back in the last recession for the way they did it. And everybody in this game is looking for somebody to blame. So the lenders don't want to take responsibility, so they're going to want to blame the surveyors, or they're going to blame the legal guys if it goes wrong.
And the surveyors are covering their PI insurance, aren't they? Of course. Absolutely. So they're worried about their PI insurance, and
that is a big thing for both the legal and the surveyors profession. It's a really tough thing for them to have to deal with. So it is hard. So those clauses are there for the right reasons, I would say. Don't see them there as the wrong reasons. They don't have a lot of choice at this moment in time based on previous history.
Yeah, definitely. I want to move on the discussion now slightly to one of the topics on our agenda, which was Brexit. That horrible word, which we haven't heard a lot about recently. I'm gonna grab the dreaded book there. Sorry, guys, don't forget to pick this up anywhere books are sold. There we go. Quick pitch on the Brexit book. I mean, ultimately, it's been quite quiet, hasn't it, on Brexit lately? And any news seems to get swept away quite quickly. But what do you think is going to happen when it does finally kick in? I guess. Will it be as bad as we thought because of COVID is overshadowing it?
Yeah, COVID's definitely overshadowed it. And I think that will probably, so bearing in mind that most of the property market is influenced by sentiment,
Yeah.
and uncertainty. And the weird thing that we're going through at the moment is normally uncertainty drives people out of the market, but this a pandemic uncertainty has driven people into the market. And we don't know whether there's going to be a short-term shift in people's views on property. I hope it isn't. I hope it's a long-term, or whether that's going to come in for the long term, and that will be critical for how we move forward. So the only thing really we can look at from Brexit perspective is what is almost go back to the sort of things that I was talking about before COVID. But so there's two economists that I follow, which is the CEBR, Centre of Economic Research for Business, I think it is, and then you've got Capital Economics. I've been tracking them for nearly 20 for about 20 years now, and they've been Capital Economics were really awful at the start. CBR weren't too bad, but they were both terrible on property. However, I have to say, since the last recession, they've got a lot better. And what they were saying was that in 10 years' time, once we've left Europe, we will be back to where we were and where we would have been. But Brexit is going to cause some economic damage in the short term. And again, it will be areas. So we think Nissan's safe in the northeast at the moment, but northeast is going to take a big dive if Nissan, for any reason, they were talking about that this morning, has to move out. So you've got to watch for things like that. How would you protect yourself if you're going to the northeast if Nissan disappears? Because
And
that's a
what do you think about
massive
London?
employer.
I mean, we've got Anil Singh. Thanks for the pre-registered question here. Will London prices fall after Brexit? And will it shift the financial sectors in Europe?
So it may shift the financial sectors, but I actually think probably COVID will have more of an effect on whether people decide to shift out of London or not, and a more immediate, sort of, immediate than it will for Brexit. But by the time we could actually physically pull out of Brexit, it's still going to be some time on, if you like. So, and it won't happen overnight, whereas obviously the pandemic has hit us overnight. So, got to remember that overall, London is still seen as a very, very safe place from a property perspective. And there's almost two London markets. You've got your average everyday person London market, and then you've got your international investor market, split between whether you've got £1 million typically or not. So from an international investor perspective, I don't think it's going to make a huge difference. They'll either want to be in London or not, and COVID will have more of a difference on that. But London, from outside as an international investor, is still seen as one of the safest places to put your money. So I think that'll kind of be
Yeah, and
fine.
I think
Yeah.
Brexit could help that. From my perspective, my opinion, sorry, is that we're an island and we're going to be seen as this sovereign island. Of course, we're the same now, but I think we'll be seen even more so with Brexit, and investors will want a piece of that to differentiate their portfolio. The higher foreign investors, the higher numbered, ultra high net worth people investing in London, that obviously spurs a lot of the high end London stuff. They're going to still want a piece of London, I believe, because it's now outside of Europe. It's going to balance their portfolio even more than some other
Yeah.
investments. So
Yeah, that's a good point. I hadn't thought about that, but yes, you're right. It does do that. I mean, Europe's got a tough job ahead of it, really, moving forward. I think, and we've seen sort of how rapidly sort of COVID spread, and for whatever reason we didn't manage to do that, stop it, even though we were an island, as much as we I'm sure everybody would like to with hindsight. So the question is whether how much Brexit really influences our market, and your everyday market rather than your kind of prime market, is how it's going to affect our economy. So yes, we might have some short-term rumbles over the next few years, but long-term, I don't think, it might be my Michael Fish moment, but I don't think it's going to have a huge impact. And again, go back to that property on the street that I mentioned. If that street where two properties comes up a year, mostly those properties are owned, or they've got low loan to values on them, and the people buying them are consultants in the hospital or GPs or food retailing senior managers, it's not going to affect that property price. So that's what you've got to always come back to. And it's also where I was sort of saying earlier, be agile. So as long as you're agile with that box that you have, that box that you buy, as long as you can slot it into universal credit when that's the best place if you're renting, as long as you can slot it into being, I don't know, some premium HMO where that's required. That's the trick to it, because we we don't know to some extent. We don't even know what the deal is going to be. But I think that in most places there's still more of a supply and demand issue, mostly because people don't move very often. So once in every 20 years is when people move. So the properties, the
Oh, is
good
that the
properties,
average? Wow.
yeah, the good properties aren't coming onto the market, and it's a very natural reason why it's 1 in 20 years. It's because most of us are old, so we
Yeah,
don't move
we're
as
an
much.
aging population and
Yeah, big time. And that's what you've got to
investing.
think about too. Is I always, if I'm looking at investment, whatever I'm doing, I'm thinking, can I rent or sell this to somebody who's over 60?
Yeah, it's a really good point. Well, Kate,
And
I think we're
I'll
going
tell
to,
you, I'll tell you, have I got time for a funny story?
yeah, go for it. I was going to
Yeah,
wrap
yeah.
up, but I'm
So,
all for a funny story.
so one of my favourite places I ever presented in was Skipton, in the northwest. I don't know if you ever been to Skipton.
I have not.
Right, so it's on a hill.
Should I go?
Okay.
Would you advise
Yes,
it?
lovely. Really, really,
Okay,
really nice place. Just two little
lovely.
stories from there. So
My
my
next day
favourite story
vacation will be
was,
in Skipton.
yeah, was always look at your population. Now Skipton basically, and this is a huge misuse of data, but basically in about, how did long to go? Maybe 5, 10 years time, everybody's going to be over 60. Okay, so I'm painting like that picture so you understand. Now in Skipton, there's a lot of hills, and there's a lot of terraced houses on those hills, right? So basically, what I used to say to people was, imagine that the road goes like that, and everybody's over 60. There's two houses you're going to buy only. Which of the two houses you're going to buy on that road? You know the answers. It goes like that. They're all
Which
over
one should I
60.
buy?
They've got their mobile scooters. That's the trick. And the ones in the middle have got steps up to them.
Okay. Am I being
You're too
thick?
young. You're too young to answer
I'm
this,
being
Nicholas.
thick.
That's the
But
problem.
is it the you're just going to buy the ones at the what
You got it
are the two
at the
ends
end.
or the
Yeah. Because I've got nowhere to park my mobile scooter otherwise, and
right?
I can't.
Okay.
I can't get up there. I just can't get up there.
Okay.
So it's where population really influences it. And down the road from there,
Interesting.
interesting, there's a little village, and they were very reliant on any rental or purchasing for a Rolls-Royce factory was there, and that Rolls-Royce factory at the time was under threat. Do you imagine just being dependent on that one Rolls-Royce factory for your rental? That disappears. Where you're going to go? So that is the crucial thing. Is it all goes back to population, what's happening in the economy? Is it a COVID and Brexit safe? I'll bring it back to Brexit because I remember why I introduced it. Is it a
Yep.
Brexit safe place? So Northeast, Nissan, not sure what's going to happen over the next 5 years. But if the biggest employer are hospitals, if the biggest employer are the local authority, if they're food retailers, if it's Amazon, you're probably going to be all right. And that's the critical thing you've got to take out of this, and then worry about property price and a rent on a street. Forget all the average rubbish that you're listening to. It's of no use to you. You've got your own personalized road data. Use that.
Yeah, no, I agree. And to end on a positive note, I think, there are some great opportunities out there right now. There's all these PD changes coming in, which are going to, office to residential. There's a couple of questions which I didn't get to on, London office to residential conversions there. I think that's going to be possible, but tougher than other sort of satellite towns around the country. And I think that, London is always tighter on all its regulations than most other places. I think there's opportunities in the care sector we talked about. It's an aging population. There's opportunities with social housing. There's opportunities with renting to lots of different demographic groups that are still booming. Don't forget, in this period, we're in this really strange period, aren't we, where the market is booming in several sectors. Online shopping is absolutely going crazy. So go and buy some properties next to the latest Amazon warehouse, and you should do pretty damn well, I would say. So it's going to be interesting times going forward. But there are opportunities. You just got to look a bit harder. You've got to be a bit more careful. You've got to do your due diligence when you're growing your portfolio at this time, and you've got to understand the markets that you're getting involved in. Thank you ever so much today, Kate, for coming on. It's been an absolute pleasure. And we appreciate you putting some time into your presentation and putting that detailed stats in. It's not often I have someone on that has that kind of level of research. You know, I tend to waffle on a lot, and so it is greatly appreciated. And thank you guys all for watching out there. You know, I hope we gave you some useful content today, some good educational content, some good news updates. Hopefully didn't waffle on too much and bore you at points. Someone said we were sending them to sleep at one point, but I think I was a bit harsh. That was only one comment, and you know, you can't please everyone. So, but it was exactly. And, you know, I think we've got to talk through various things. You know, we're bouncing ideas off each other. You come up with stuff, don't you? And I think it's good to kind of brainstorm these kind of ideas. And thanks for all your pre-registered questions. Those of you that have you know, signed on or watching today, those that are remaining watching, and we are still about 3/4 of the people watching. So thank you for sticking with us right to the end. Make sure you subscribe to the channel. Click the bell icon, get those notifications. Sorry if it sounds boring that I ask you to do that. If you don't get it, you're not going to get notified when we're live. And we might do some random lives. We're uploading at least 1 or 2 videos a week. So you'll get notified of those and get some more good free educational content from Property Forum. So thank you very much for having us today. It's been an absolute pleasure. Thanks again to Kate, and we'll see you again very soon. Take care. Bye-bye. Thank you.